Hey, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. We are recording this on Thursday, April 23rd, and I'm delighted to be joined by previous guest and legend, Dr. David Kelly from JP Morgan. Welcome, David. Thanks for joining us here.
Very glad to be here.
Well, with no further ado, because we have a lot to discuss, let me pull up the slides. Call this podcast a marathon and not a sprint, as David and I both share the honor of having been running together in the Boston Marathon last week and this week, should I say? It feels like a week ago. And congratulations, David was far more consistent than me and had to put in a far better time than I did. But for neither of us was this our first time, and I think it's important to reflect on that time, and we will get into that in just one second. And in terms of our usual things we discuss on this podcast, we will, after discussing the marathon, cycle through inflation, interest rates, geopolitics, equity markets, and other asset classes. And first, we're going to do a Boston Marathon redux, compare our experiences, and relate them a little bit to some of the dynamics that we're seeing in markets. Just as for me, at least, the Boston Marathon was a downhill struggle. We'll speak about inflation. We're going to refer to a landmark that David has referred to on more than one occasion with respect to inflation. We'll look at regime change at the Fed and what they may mean, if that is in fact what is going to occur. We're going to reflect on equity markets, the ongoing FOMO, and the potential for some April showers when it comes to some of that FOMO. And then, as always, reflect on portfolio implications. Here's David Kelly, needs no introduction, but I will let you read that to your own devices. But let's then, David, speak about the marathon. So first I should ask, are you going up and down stairs with your usual spring in your step these days?
No, no, not quite. Pretty much crab-like. So the trick is you have to go upstairs sideways, clinging on to things, but for about 3 or 4 days afterwards. But I'm hoping that by the weekend I'll be actually able to go up and down stairs again.
Well, similar. I say that what I find the most unpleasant part of that is going up and down subway steps where you have to
Mhm.
cling on to a dubious handrail for dear life. So I've had a lot of that on the New York Metro. And let's talk about the downhills because you, I think, after when we quickly shared our experience, spoke about the downhills of Boston as a cautionary tale. And we've also spoken in markets about how going downhill is precisely where the mistakes can be made, whether that's inflation coming downhill or interest rates coming downhill. What is the trick for navigating Boston's downhills?
Well, the trick is just take it very easy. Don't try and you don't try and bank time. You try and bank energy. And I think the analogy for markets is when markets are doing really well, it seems really easy. Just be careful because it's just too easy to get too enthusiastic, and then you will inevitably pay for it later. And that is usually what happens in Boston. People get too enthusiastic at the start. You see that nice downhill, looks very easy. And then come Heartbreak Hill on mile 21 there, they have to pay the price.
And we have highlighted Heartbreak Hill for the uninitiated on this little graph on the page there at the very end at a painful spot. And I think you also mentioned the weather was so perfect on Monday that that's actually the kind of conditions that lead you to perhaps overconfident. I think if the weather had been like it was for my daughter, 80 degrees in LA recently, we might have actually conserved energy. So I think that's another analogy with markets when things seem too perfect, that's somewhere where the largest risk is taken.
Well, that's right. I mean, you actually, from an economic backdrop, you want kind of cool weather for profits to do very well. The economy seems like a cool climate. So you've got slow growth, you don't have too much wage growth, you don't have too much in the way of interest rates. That tends to be where profits grow and markets do very well. And equally in Boston, you want a nice cool day. It's the best day is something in the 40s, which is what we got on Monday. So you think you want it somewhat hotter, but actually it's really important to have just cool, steady weather in order to run a marathon.
Absolutely. And you, this was my fourth time running Boston. I think how many times have you run it now?
This was the eighth consecutive.
Eighth consecutive. Okay, so a bit of pattern recognition on your part. And I suppose looking at markets and patterns, we are often drawn to pattern recognition, but how much would you say that traditional pattern recognition is working these days in your analysis of markets?
Not very well. I mean, the thing is that that chart you've got there, they actually have it sort of laminated in in marathon sports in Wellesley because the actual course of the Boston Marathon hasn't really changed in the last 100 years. But of course, with markets, things do change over time. What we found is that some of the down, the declines in markets are shorter and the rallies are longer. And so we're getting these sort of strong, long rallies in markets without many bear markets. And that can lull you into certain sort of complacency here. But I do think that the patterns change over time as economic forces, as the economy evolves, but also as the economy gets hit by different kinds of shocks.
And I think the other thing I was thinking of, first of all, Boston is so soul destroying if you're struggling as I was, because the competition is so good. The benchmark, the average benchmark out there is just so high. And it's obviously in markets, you have to ask yourself if I'm comparing myself to a benchmark or to my own customized benchmark, my own personal objective. How do you approach Boston?
Well, first of all, I think you have to start with discipline, and then you try to get small advantages in little things. I mean, you're showing those, super shoes. I mean, I do run. I run in Alpha Flies, which have got lots of extra cushioning, but they're extremely light. It just gives you an extra percent or maybe 2% in terms of speed. But you're always looking for little edges, and I think that's true in investing too. You've got the basic plan has to be very stable and balanced. But then you just try and pick up alpha wherever you can. And I think you do that too in terms of running. You're always, changing what I'm going to eat a little bit or when I'm going to drink or some exercise you're going to do to strengthen your quads. So there are always all these little things to improve performance rather than change your plan dramatically. That's not what you should do. You should just make small changes to try and improve what is basically a conservative plan.
Well, you've answered my last question, which was how much you go in for the new innovation. It sounds like you do go in for it, but with managed expectations, not expecting it to be big swing type of innovation, but to be incremental and that kind of the approach to slow and steady improvement.
Well, that's true, but I also bring I don't actually eat gels. I eat Christmas cake, which you and I even remember good Irish Christmas cake. So I find that to be the best possible fuel for marathons.
Well, it's going out there now. It's going to be patented. So I suppose that sounds like the most dense, popular, possible marathon snack.
It
So
is.
fascinating secret. Well, let's move on to more pedestrian, you could say, pursuits now and speak about inflation. So I've always loved your analogies, and that's why I think you're so popular in the space of financial commentary. We've spoken about the Eiffel Tower. Went back to our previous podcast just to make sure I got it right. The Eiffel Tower of inflation and inflation going up steeply and then coming down steeply. And where we are, obviously, different patterns in Europe, the UK, US, but for the most part, inflation down, but not yet out. And then, of course, with the recent geopolitics, a bit of a wild card there. What's your current take on the trajectory of inflation and what the near term is likely to look like?
Well, this is a very good analogy. Actually, it was my friend Andy Goldberg who I think came up with the idea that if you see the left-hand side of the Eiffel Tower, eventually you're going to see the right-hand side of the Eiffel Tower in markets, but it's also true in inflation. I think if you took the little chart that you've got up on the left there, if you stretched out, you could stretch that all the way back to 1980, and you would see a steady decline in inflation until we got hit by the pandemic. We got hit by the pandemic and the policy response, so not enough supply and way too much demand. And then we got that doubled up again in with the invasion of Ukraine. And those two things caused a temporary surge in inflation, but as you can see, it went away. Now, we're doing this again, I hope, on a more minor scale with the war with Iran. And that's also causing a surge in inflation. But beneath it, this is not an inflation-prone economy. So eventually, we're going to get to an equilibrium with Iran. We kind of have to. And that equilibrium is going to essentially mean that if everybody gets their oil out of the Gulf, Iran's going to get its oil out of the Gulf. And so I think we will restore supplies. The longer it goes, of course, the more damage to the economy. But ultimately, I think once that happens, I think you get oil flowing again, oil prices come down. I think tariff rates at the end of this year are going to be lower than last year. And I think that things like shelter costs, which were a big source of inflation in the last few years, things like apartment rents, those are actually backing off a lot. And so I honestly think that inflation could fall below 2% again in 2027. Maybe not quite by the end of 2026. We'll have to see how oil prices move. But by sometime early in 2027, I think it'll be down below 2% year over year. So I do think inflation is going to come down again. But between now and sort of the middle of the year, July, I think we're going to see some pretty rough numbers in inflation because of what's going on in the Middle East.
That's really interesting, the concept of an inflation-prone economy. And I suppose if it's not inflation-prone, is that because you don't see the consumer as being sufficiently robust to drive that demand side inflation? Is it because of deflationary forces that have really been around for years? They've come and gone, or other factors behind that?
It's three big deflationary forces that have been operating over time. So the first of them is that since the 1980s, the income distribution in America has been getting more and more and more unequal. The top 10% of households, they control 75% of the wealth, they control by one measure 50% of the income, and they get that chunk has been getting bigger and bigger and bigger over time. Now, why is that important? Because the big difference in the consumer behavior of the rich compared to everybody else is the rich actually save some money. The rich save about 30, the richest 10% save about 35% of their income. Everybody else saves zero. So what happens is when more and more money gravitates towards the richest households, that money then gets diverted to buying stocks and bonds instead of goods and services. And so you end up starving the markets for goods and services of demand while you're increasing demand for stocks and bonds. And that's why, you go back over the last 40 years, the average CPI inflation rate is about 3%. The average increase in the equity market or total return in the equity market is about 12%. So I think that's part of it. I think also the demise of trade unions, less than 6% of the private sector is now in a union. Workers just don't have the bargaining power to get wage increases. And then information technology. I mean, information technology helps buyers because sellers always know more about the thing they're selling than buyers do. But the more information buyers get, the more they're able to really enforce competition in markets they were never able to enforce it before. So, if you buy an airline ticket, you buy a shirt, you buy a book, anything that you buy, any good or service that you buy, you've got an ability to compete, may force the seller to compete in a way that was never true before. All these are very long-term forces, and they really have eroded inflation. And it took an extraordinary shock in terms of the pandemic and the policy response in Ukraine to actually give us a bout of inflation. We've now got a smaller but still extraordinary shock right now with the closing of the Strait of Hormuz. But ultimately, this is not an inflation-prone economy anymore. And if you take these shocks away, the inflation rate will tend to drift downwards.
And just before moving to what that means for interest rates, because I would imagine a non-inflation prone economy would give some leeway for a more lenient interest rate approach and certainly an easier approach to rates if we're not as concerned. I think this is behind the landmark, just more other pointers around food prices, all of this affecting that lower end consumer that you mentioned and clearly clear price at the pump. So moving then to the Fed implications, we're in the middle of confirmation hearings. We know that there's a discussion around regime change at the Fed. And I'm not sure that markets or investors are particularly in the mood for a lot of regime change, having really got into a rhythm of knowing how to read Jerome Powell and the telegraphing that goes on there. And we're just back to having a few expectations of rate cuts in the consensus. Do you have a view on the current Fed policy, whether there's likely to be a big rupture or change to that?
I don't think there will be. Obviously, I listened very carefully to Kevin Warsh's testimony to the Senate Banking Committee, and as he tries to get confirmed here, he's talked about less communication from the Fed or less forward guidance. I don't have a problem with too much of a problem with forward guidance and interest rates. I actually think the forward guidance should be we're going to get you to the right place and keep it there. I do think they should provide guidance on what they think the economy is going to do. But he's also said he wants a smaller balance sheet. And that makes for a great bumper sticker. How cut the balance sheet? That's a big, big bloated balance sheet. We've got to cut back in the balance sheet. Yeah, but how are you going to do that? And it's a very complicated story, both on the asset side and the liability side of the balance sheet. And we're not going to have enough time. We need months to go through the whole thing. But I will say it cannot be done without inflicting some pain somewhere. So if you look at the assets of the Federal Reserve, they contain a lot of long-term treasury bonds, a lot of mortgages. If you sell them off, you're going to push up long-term interest rates and mortgage rates. I'm not sure that anybody wants to do that. But more than that, I think whoever is the next Fed, or when Kevin Warsh becomes Fed chair, which I think he will be chairman, not chief. He will have to convince the other 11 voting members of the Federal Open Market Committee to move in the direction he wants to move things. And I think that's going to be very incremental progress until we're sure that inflation has actually come back down below 2%.
That's a really interesting distinction. I think chairman, not chief. And I think we've definitely conflated the two in the coverage, and maybe it's around this kind of personality focus. And again, it seems like the media has been focused on change at the top of Apple. And we have become very focused perhaps on the personalities of the leaders and less on their actual power and maybe that kind of the tribe that's behind them. Going now to the economic vibes as well as just this movement in equities and its resilience around the oil price. And whereas in the past we had the oil price rising, energy and equities falling, and we've actually had equities just reach new highs now. How do you characterize this resilience? We talked about the consumer and the lower end and the higher end consumer and earnings. Is there anything you point to, or just a combination of factors? How are you understanding this relentless resilience?
Well, I think it's actually a big long-term story that has got very little to do with oil or the current crisis. But I think this has been building for a long time. I mean, remember I talked about how we've had a 12% total return annualized from the stock market for the last 40 years. Just an extraordinary number. Well, where's that coming from? I mean, part of it is actually what I said earlier about more income in the hands of the richest 10%. So we've got this money sloshing into the hands of the richest households who then buy stocks and bonds with it. So I think that is helping the stock market out. You've got this fever on, or this big movement towards stock buybacks as a way of distributing cash as opposed to dividends. I mean, last year, companies spent $1 trillion of stock buybacks. They only paid out $600 billion, or 60% of that, in dividends. Well, and the difference, of course, is you receive a dividend, you can do with whatever with it. But if a company does a stock buyback, that's $1 trillion on the table to buy stocks right at the start of the year, and so that helps. And then we've had a sea change in retirement plans. It used to be these balanced defined benefit plans. Now we've got defined contribution plans, and they're not balanced at all. It's all in on equities, and so you've got this constant flow of money every week. Money's going from paychecks into the equity market. It's quite hard to get it out because if it's in a taxable account, you have to pay a huge capital gains tax to get it out. So it's almost like this extra flow of money going into the equity market year after year after year because of institutional changes in our markets. And I think that is why, despite a lot of uncertainty, we've had this enormous surge in equity markets, particularly over the last 4 years, but really dating back over the last 40 years.
And that's a classic technical factor, right? That's not even grounded in fundamentals. Do you see
Exactly.
fundamentals as kind of more supporting that? In that we know that earnings, and I have some other slides here in terms of earnings doing quite a bit of heavy lifting. This would be more the previous chart was more of the kind of the economic vibe, and we can come back to that. But earnings have been really sustained. Do you see anything, any kind of perhaps reason for that that is not the typical reason? Has it been perhaps headcount cuts or cost cutting, pricing power, and the fact that earnings are so well sustained in the US but less well sustained elsewhere? Anything, how do you characterize the earnings?
Well, I think the earnings we're off to a very good start in the earnings season. I think we're going to see earnings bolstered this year, particularly in the second quarter and thereafter, by higher energy prices for our energy companies, because obviously we are a net exporter. I also think that if you listen to sort of companies like the airlines, now the airlines are famous for not ever making much money, but it does seem like there is a determination among consumer companies that they are going to pass on cost increases to consumers. And also workers are very gloomy, and they're not asking for big pay increases. I mean, the last month we saw wage growth come in at its slowest year-over-year level in almost 5 years. And so even though you've got a tight labor market, you've got these gloomy workers who aren't asking for pay increases. Meanwhile, companies are able to push up their output prices, and that's giving us good earnings numbers. So this is not a good economy for the average worker. You've got some inflation. You don't have much wage growth. I think people feel pretty stuck and not really getting ahead. But in terms of relatively low interest rates and strong earnings growth, it's a very good economy, and it partially explains the strength of the stock market.
That is a fascinating, I'm always going to say conspiracy theory, but I use those words, not you, in terms of the manipulation of sentiment around jobs. And some of that is around AI and replacement, because we looked at record low consumer sentiment numbers around the Michigan numbers, I think a few weeks ago. We've also
Yep.
nothing but headlines around the plight of the new college graduate. And certainly all of the rhetoric would tend towards not putting much power in the hands of labor, and certainly the
Yeah.
way AI is moving. And then if
Yeah. I
you
mean,
have, on the other hand, some high profile headcount cuts, that probably lends to that. But in a sense, that doesn't need to necessarily square with it being bad for labor. The belief that it's bad could well sit at odds with whether it is bad or not.
Oh yeah, absolutely. I mean, in a narrow sense, there must be 50 ways to stiff the workers, and I think American business knows all of the tricks. And so there's always a reason why we want to give you a wage increase, but not today. But I think more broadly, isn't it a fascinating time that we live in? I mean, I feel a little Dickensian almost in saying that it is the worst of times in sentiment and the best of times in the stock market. We have literally in the last week seen an all-time record low in consumer sentiment and an all-time record high in the stock market. And I don't think either of those really reflect reality. But in terms of sentiment, yes, I mean, I think that, the overall economic numbers aren't great. I think sentiment also, it's very egalitarian. Everyone gets one vote. And I do think this economy is working much better for the top 10, top 20% of households than everybody else. And I think low sentiment is a reflection of that. But we're also, we're glued to this social media. I mean, people walk around with their heads, glued to their scroll and all this nonsense from social media. It's designed to do one thing. It's designed to make you very angry and very scared. And people are reading this fearful stuff, which is just messing with their minds. I mean, it's been going on for years, but it's getting worse. And I think that combination of just really, bad news and then actual inequality, but this feed of just negative news is really doing a number on sentiment, even though the economy itself is okay. And of course, the economy as it relates to companies, for the economy relates to companies, not about living standards, it's about profits and interest rates. You got strong profits, low interest rates. It's great for the stock market.
It's fascinating. And when you mentioned that, this was just a touch on the positive sentiment, say the best of times. And then I go back to my economic vibe check, which could be again indicative of the worst of times. And I'm going to give you my vantage point from Europe. And here we were talking about global growth slowing to its weakest since the pandemic, according to the IMF. Stagflation has been on everyone's lips in Europe. I've spent a lot of time thinking about how to insure a portfolio against stagflation, which has not been some of the traditional stressors. And then when we look at the economy in terms of the Eurozone surprise index, the Eurozone seems to be negative surprise is the order of the day. There hasn't been that innovation. There's more regulation. I know you've always been an advocate of global diversification. How are you seeing this, whether it's the best of times, worst of times, play out? We don't have the same resilience, I think it's fair to say, outside the US.
Well, and I think it is somewhat psychological. I mean, the biggest difference I see, having lived some of my life in Europe and lived in America, is when it comes to consumers. When things get tough in Europe, they batten down the hatches and stop spending. In America, when people get scared, they go out spending to relieve their nerves. I mean, we spend addictively in this country. And so you just don't see that drop off in consumer spending at all when consumer sentiment falls. And that's part of American resilience. But I would say this, that I think that this is a little bit of a false dawn, or, getting back to your marathon analogy. It's like the first few miles of a marathon. It feels very easy in the US right now, but that's because we're not seeing the ultimate impact of the closing of Strait of Hormuz and oil prices. If this keeps going for another month or another 2 months, suddenly you're going to see some significant increases in global oil prices, and that will affect sentiment around the world. Um, Conversely, I do think that ultimately the US is going to have to fold up its tents and figure out some solution with Iran, some sort of equilibrium, because it cannot keep the fleet stuck in the Gulf of Oman forevermore with oil prices rising. Therefore, there will be some agreement at some stage. I just think the administration now has to figure out how it's going to come up with an agreement and with whom it's going to come up with an agreement. But perhaps something that they should have considered before they got into this mess. But ultimately, that's how it's going to have to end.
It's a fascinating, and then I think before we move on to one last topic, which I'd love to just touch on private credit, I think it's important. One of the key underpinnings of resilience has been the tech story. More best of times, worst of times there in terms of whether it's the concern around job losses. But one of the theses I'd love to just run past you is this thesis that's been doing the rounds this week, which is around the next leg up in AI automation transformation being the mid cap segments, being the 50-person companies who don't have a bunch of coders, who perhaps don't have the millions of tokens, but could enjoy a productivity unlock once
Mhm.
some of the benefits of AI are enjoyed. And that may be driving some of the run up in the Russell 2000 that we've seen just over the last, say, number of trading days. Any thoughts on that rotation from large cap into mid and small?
Yeah, I think that makes sense. I mean, this is a technology which is going to be the most powerful technology humans have ever seen. I mean, it is one of the things that sort of make we've been working on long-term capital market assumptions, and when you're forced to look at this over a not just a 2-year lens, but over a 10-year to 15-year lens, it really can have dramatic impacts as also as we see more innovation in robotics. There are certain industries where it's going to replace jobs. I think it's going to accelerate over time because what's happening is you're going to have increasing tech. You're going to have three things going on at the same time. One, the technical capabilities of these AI models keeps on getting better. Two, the cost of these AI models in terms of doing tasks, assigned tasks, is going to get cheaper. And third, you've got a diffusion of AI where more companies are going to have to embrace it because they just cannot stand the competition. And so you're going to have that diffusion of AI technology impacting things also. And so I think you put those things together, it is going to be transformative and it's going to be more dramatic in its transformational effects, 5 to 10 years from now than in the next 5 years. But it's having an impact today. The real question is whether the transformation will be so rapid that we always used to find, well, we'll find new jobs to do, and maybe we will find new jobs to do, but there may be periods over the next 5 to 10 years where we just cannot come up with enough new jobs that humans can do better than a combination of AI and robotics. And that's a little scary. Is that you may in the end end up not with what Marx would have called a reserve army of the unemployed. You may end up with a reserve army of the unemployable, people who aren't more agile than the clumsiest robot or smarter than the stupidest AI. And if that's you, then you got a problem. And so I hate to leave it on such a gloomy note, but I do think it's going to transform society, and we better come to grips with it.
Well, it's interesting getting back to the Europeans not being perhaps as avid spenders. They are avid attainers of university degrees. We know that
Yeah.
there's an ability to learn, and perhaps they're late adopters with some of the AI tools. But maybe that is when things have settled a little bit and we can discern which one to choose. So I do think that same thesis of mid-cap AI integration could well apply to the wave of European companies. So just one more topic, if you'll indulge me, and that
Sure.
which is really on the private credit side. So we talk about concentration in equity markets, and clearly there's concentration perceived in those funds as well, with the concentration of around 20% around software. And that seems we've seen some pretty high profile one just today mentioned. Now, as far as going around the strain of private credit, the pressure on some of the quarterly funds, do you see a particular pressure at this point in terms of the private credit arena? Do you think there's another shoe to drop, a cockroach to appear, or how are you thinking about this segment of the asset allocation?
Well, I think the key is it's not systematic or systemic. So you will have companies get into more trouble to the extent that private credit has been extended unwisely. I think there's not enough regulation, and there's a rather incestuous relationship between private equity and private credit companies, and so you're going to have some blow ups, and over time that's bound to happen. So long as the economy continues to grow, though, these can be spaced out because unlike stock markets, which work entirely off sentiment in the short run, for private credit, you can't get all your money. Well, that's kind of the deal. It's gated. You can't get all your money. It doesn't mean they're going bankrupt. You're just not allowed to have all your money. That's the deal you signed up for. A lot of companies can find ways of amending and extending loan agreements so that private credit doesn't actually go bad. And even if it does go bad, then over time you can sort of space that out. It's kind of like the huge office vacancies we saw. That didn't cause a massive collapse in the economy because even though there is a genuine problem, it can be spaced out over time. I am not seeing huge derivative exposure across the banking industry to this. I don't think there's any particular event which is going to cause all these companies to collapse at the same time. So I think you got to be careful. There's more than one cockroach. I mean, the way I perhaps it's maybe there are cockroaches in fraternities too, but I think to me it's a little bit like leaving off a keg of beer at a fraternity and then driving away. You know something bad's going to happen. You just don't know what it is. And when you pour this much money into a sector, you know something's going to go wrong. but you just don't know what it is. You just have to be a little bit more careful about who you're having manage your money and their actual expertise and track record in the space of private credit.
Well, I think it's probably quite, as was memorable, appropriate that we've ended. Talked about marathons at the beginning. We've ended talking about kegs of beer. For many, the two go hand in hand. If we're going to bring the party analogy, there is an analogy for leaving the party before you're standing on the shreds of broken glass on the floor. So perhaps on the private credit side, that's what some investors are calling. Well, thank you so much, David. This has, as always, been a fascinating tour through so many asset classes through the market. I will now stop sharing and just go back to our normal screen. It
Mhm.
has been every time, every step I took, every mile post, I thought during the marathon, what would David Kelly be doing at this point? And I said, probably doing a lot better than me. But it was great to know you were out there running and to see the great results. Great to compare our marathon and our market insights. And thank you so much for coming here and sharing your insights with us.
Oh, anytime, Ethan, and I hope next year we'll lace them up again, and maybe we'll get different weather, and it'll be a different result. But look forward to running the marathon with you again.